Hello and welcome to today's video, which is called Stock Stopping Out. Well, this is kind of a provocative question, but I bet you have already reviewed the How Close S&P Top video from earlier last week, where I talked the sequence, the likely targets, and so on. So today the title refers to the pre-market action and the attempted retracement that thus far goes more or less quite well. For sure you are already familiar with yesterday's analysis that had been posted on my site. Do remember that this forms the basis just as much as the Twitter and Telegram for notifications and two-way discussions, and of course this YouTube channel though. So thank you for subscribing, commenting, liking and questioning. Your market questions really help refine the style and the focus. It's excellent, so please do keep talking. So let's move into stocks. Today I will provide you with an intraday overview, as the analysis is still premium, but stay tuned for tomorrow, where I would more or less refer to what I had written on Sunday, premium to subscribers. So, the big picture that is true both in the short term, intraday very short term, and over the weeks to months ahead, is that tech is to remain under more selling pressure than cyclicals or value stocks. And you remember the sectors that I had been cherry picking for you lately as the best candidates, be it energy, be it materials, be it industrials, and of course remember my big question mark over financials, and what formed the basis of my criticism that we are not in a new bull market. Financials should be doing better than they had been doing up till this moment, if I consider all their performance, whether it is from the October or December low. So please do review the Saturday's video, where I talk the reasoning why we are not in a larger bull market. Have we overcome all-time highs anyway, so that it would qualify as a bull market? No, this is still thus far only a correction. So please make sure to review Saturday's video, where I talk these segments and points and other points to a much greater depth than I'm doing right now. Following up on the intraday recap review, how things look before the states fully wake up and markets open, stocks are attempting to overcome the Asian session weakness, and Alibaba is likely to keep building on Friday's positive turn for quite a while, even in the absence of fresh China stimulus. That encouragement to invest on the mainland must be doing wonders. Also, look at DAX, how it's showing versus American stocks today. And also remember the tendencies of friendshoring that I had mentioned in latest tweets. The relative importance of Mexico trade for the US had grown up, whereas the relative importance of China, meaning the deficits that European countries, including the UK, run with China, has steepened, so we see quite a rebalancing. So that's part of the explanation why DAX is doing that much better today than S&P 500. Remember that big picture, we are still part of the S&P 500 topping process, and that's the earlier mentioned video from the beginning of prior week, which I hope you had already reviewed. For now, best things to do in this current week, which is bringing us quite a few banking earnings as well, is to keep in touch with momentum and how strongly are the rotations going to play out. So, you know my characteristic intermarket and sectoral style, where I look as well into currencies. So that would be what I would highlight from this week's toolbox. And I could have added easily one more bullet point. Let's see whether I have it in the following slide. No, I don't have it. So let me say it right now before jumping into this chart. What I consider to be the key data points of this week is to be CPI, and then with a certain distance following PPI. So it's Wednesday over Thursday, and I consider the upcoming figures to likely confirm the disinflationary trend, both in headline and in core readings. And that means it would of course trigger more bets on Fed taking its foot off the pedal, and that would probably not work to immediately send stocks to the downside. So I'm not looking for Wednesday's data to trigger a steep sell-off. When it comes to the data point itself, I think that we are drifting to the mid 3%, maybe 3.6% on CPI on a year-on-year basis, slowly over the upcoming months. Yet when autumn comes, and during this season, we would see inflation kicking back in, because job market is not collapsing and oil prices would have a fine finish to the year. So let's move into the real assets update, which is what this chart is about. It's an intraday 30-minute one of gold, and I see a certain kind of inability / rejection in attempts for appreciation, and that would likely be reflected over the coming trading sessions chiefly in gold rather than in silver. See that within the currency pair of every USD, the dollar part is improving today. So we are seeing similar kind of rejection, which would work to keep a lid on gold today. Crude oil I consider sideways for today, not in danger of a steep sell down, nothing in terms of a steep appreciation either. It would be a very slightly corrective day. Just as precious metals, sorry for the autocorrect, is capitalized, of course. The Run on Friday's non-farm payrolls was a bit too steep in both precious metals and in crude oil, whereas copper had been refusing to follow through on that strength and today remains weakest of the pack, which is not the finest sign for commodities overall. That's something that would catch up over the upcoming sessions. For today, I think that the $3.75 to $3.74 area would provide intraday support and prevent the red metal from declining below that, even if the dollar starts appreciating during the regular session later today. This is the kind of updates that is reflected both in the all-encompassing trading signals publication of mine that covers all the asset classes, and it's something very similar what I'm doing regarding S&P 500 in the intraday signals when it comes to stocks. So this is the chart format and the style of commentary, how I interlace the very short term and big picture. Once again, recapping, make sure that you are subscribed to the freely obtainable daily analysis on my site and that you follow me on Twitter and Telegram and keep commenting, talking, and let's refine the best outcomes that work for you precisely. Side times apply. Be familiar with my journey and aware of impersonators on social media. To top it off, the obligatory disclaimer. Thank you very much and see you later again on Twitter.